You don't need more revenue, maybe. You need a rhythm and a profit plan. If you ever felt like your income was growing, but your wealth wasn't, this episode is for you. Let's talk about what it really means to design wealth, not chase it. Stay tuned. Hey there, lovely. Welcome to another episode of Harmonious Wealth. My name is Iyanna Vaughn. I am the lead financial strategist, fractional CFO, owner, founder of Lovely Financials Group, and your host for Harmonious Wealth. And today, if you know me, if you're a client of mine, I get extremely geeky when I talk about like spreadsheets and strategy, financial strategy in particular. And today we are diving deep inside of that. So if you are listening the to the audio version, I highly recommend you watch the YouTube version as well so that you can get a feel of what I'm going to talk about because I will be sharing my screen when I talk about the profit plan. And we're continuing on with the last part of our series for my signature framework, the Overflow Method. And we are going over the fourth step, which is wealth flow design. And this is where we create a system where we have like stewardship mixed with strategy so that we can have a plan for the next calendar year for you. And this is all in part of our financial strategy experience services. And when we create a profit plan, you might come in as a client with your goals, right? I will never tell you cannot hit a goal. However, I will show you where you are right now and then the gap between your goal, which we talked about in yesterday's episode. But today we're talking about, I'm giving you an example of how we work through our clients with our profit plan. So the first thing before we hop in, right? We already know, I feel like I might be busting you over the head with this, but like revenue, of course, does not build wealth. Revenue definitely helps, but maintaining your business with your profit as well as managing your cash flow is going to help you produce wealth. I've also said this before. There are the 4 different cash flow quadrants when it comes to building wealth as a person based off of the book Cash Flow Quadrant by Robert Kiyosaki. The first one will be like an employee, you're trading hours for dollars. The second one will be your self employment. So you might start your business as a 1099 contractor, or you might just be a solopreneur. Nothing wrong with that. However, you are the main owner and the main person who, like, you're giving the service, you're delivering the service, right? So that means you're self employed. Then you go on to having a business where your processes and your team is able to execute on your behalf. That builds wealth because then your profit is able to grow without you. And then you're able to use your profit to then pay yourself above and beyond just your owner's pay, but more so like paying yourself to have investments, which is a step 4, which is the fourth part of the cash flow quadrant where your money is making money for you as an investor. So as an investor, you can buy more businesses, you can invest in the market, you can invest in real estate. The sky is the limit essentially. But in order to be able to have the cash to be able to invest or build wealth, I am a believer that your business can help you do that through increasing your profits. So that is why I call the fourth step wealth flow design. Now, with our FSE, aka our financial strategy experience services, we help our clients create an annual profit plan every single year. For our Overflow CFO services, which is our fractional CFO services, we do a profit plan for the next 3 years so that we can see from a bird's eye view, where's the business going? What is the trajectory of cash flow? And then also with our CFO clients, we do like an annual valuation so that we can see, okay, what is the value of your company based off of where you are? So that's the difference here. If you've ever, I'll probably do another series all about our Overflow CFO services. So with our CFO services, the biggest difference is more long-term planning, more hands-on, and then also leading your whole entire financial department and working with your operations department to make things seamless. And then also getting privy to like your marketing efforts so that I can see how I can help, my team can see how we can help you reach your goals. So without further ado, I want to share our profit plan. It is tea, okay? So I'm going to go ahead and share my screen and get started. Oh my goodness, I'm so excited. All right, so first up, we have our CEO salary calculator. These are just kind of like example numbers. So I'm going to just do a quick overview because we're really going over the profit plan. But as I said before, it all starts with your CEO salary so that we can figure out what you need to pay yourself. Period, point blank. So the first thing is looking over this. We want to live off of 50% of our take home pay. So that's why I have that here. If you go to lovelyfinancials.com/CEO, you can get your free CEO salary calculator and you'll have this exact document. But we go into more detail with our clients. So, anyway, we have first up our fixed expenses. And then that includes to me, like your home expenses, obvious, like your mortgage, HOA, water, electricity, groceries, all of those different things. And then other fixed expenses can be like tuition, school lunch, housekeeping, laundry service, those things as well. And then debt is kind of like a fixed expense because so debt is technically a liability. However, if you pay on it monthly, it could seem like an expense. That's why I put that down here. So like your minimum, so that's why I put in here in parentheses minimum. And then I just kind of put in like examples because sometimes with home insurance, if you have a mortgage, you won't necessarily pay that out of like your account. It'll be in your escrow when you pay on your mortgage. That's kind of why I have those things. And then sometimes like your health insurance can be through your business, blah, 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 blah. And then I have like the student loan right here, and that's just the minimum payment. And then the total home expenses are going to be, for this example, 4,500. Then we have our other extracurricular children expenses. And then that includes like clothing and like extracurricular activities. And then what I like to do here is have actually, in this example, I added in child activities as part of the fixed expenses. No biggie. So that actually is for total living expenses just under 4,800. And then I added a buffer for just a 15% because life happens. That's an additional $717. So that means here with that 4,800 plus the 717, the fixed cost now is just under 5,500. Not bad. It is what it is, right? And then with this, I put in next flexible spending. So that can be takeout, for subscriptions, gas, all those different things, and also adult clothing. So to me, children clothing is kind of a fixed cost because children grow every 3 months, really every few weeks, depending on the stage of your child. And every time you turn around, you got to buy clothes for your child because back to school, then winter, then spring, because they're growing, right? So, and then as an adult, we're, the same size. So we don't necessarily have to, it's not a fixed cost. So that's just my thinking process. If you don't agree, that's fine. You could just kind of put it in a different area. No biggie. And then other flexible, I put in tithing here as well. That's just for me. So that's why I put it in flexible. I would personally put it in fixed. Not a big deal. Wherever you put it is where you put it. And then now that we have that, we have the 50%, right? And then out of the 50%, we have 24% going towards your flexible spending based off of your total flexible spending, which was about 1,400 plus the other flexible spending, which was just under 1,200. So that adds up to just under 2,700. And then what's left over is going to be what you use to build wealth. 100% is basically your total pay minus the 50, minus 24. Now we have 26% left in your take home pay to use towards building wealth. And that is a total of 2,800 for this example. So I put in savings, I put in parentheses 10% of take home pay, extra debt 10%, and then investments 5% for this example. Now, right here in this salmon color, if you are looking on the YouTube version, you can put in like your other sources of income. So then that way your business doesn't have to take the hit or like have to be the carrier of all things, your income. In this example, the business is like the only source of income. And then for this example, I love this. It gives you two different scenarios of what a peak of what your revenue should be based off of your ideal take home pay. Okay, so there's two different things. Excuse my scream. I like to like squeal when I get excited about things, so just FYI. But anyway, we have an ideal income. Let me bring this over. So basically, just kind of doubling your salary or your take home pay. And then here is like if you have a team. So if you're like a solopreneur or you have just like minimum expenses, I would go with this good one. And then the better is like if you have a full team. Take this in, just breathe. If you want to do it with me, go to lovelyfinancials.com/CEO. Okay. So next tab is the key path diagnostic. I talked about this yesterday, but I felt like there was I wanted to talk about it and share it because it goes into our wealth flow design, which is a profit plan. And I am a person who loves one agenda for the year, one spreadsheet for the year so that we're not like a mouse looking for like different traps of spreadsheets or like documents. So this is one living, breathing document that we work on with our clients. And it just made chef's kiss. It just made my life simpler. And it made our clients' life simpler because now there's only one document to go to. So without further ado, here is the key path diagnostic. This is what we work on with our clients when we first onboard, and then we revisit it after 6 months of working together. Essentially, it goes over the past 6 months of data of your revenue. So that's why I have months 1 through 6 here, and then it gets an average. So this example has two different revenue sources, which is retainer services versus project-based services. So this is just like the numbers here, and then the average revenue for this business is $30,142. This is where I get excited, is the percentage of revenue. So percentages rule my life, okay? They rule. When a client brings up or has emotion about their profit or lack thereof profit, I'm always reaching back for percent so that I can explain what transpired. And I'll show you what this means here. So for this example, they have a pretty lean team. They have an ops manager, delivery assistant, and marketing assistant. So delivery assistant can be like whoever helps you deliver on your service. Cool. And then it goes into the operating expenses. But before we get there, we have total team costs and we have an average, but it's just kind of straightforward. So here we have team at 17.6%, which is just under 18%. I have different thoughts of what your team cost should be based off of your recurring revenue or your average revenue. I can have a separate episode if you'd like. Let me know in the comments or just DM me. Okay, anyway, we have our other expenses, our operating expenses. I like to separate team versus operating. And then we have our total expenses, which includes team. And then our profit before owner's pay. I call it AKA PBP. I mean, I never say that. I just said that here. I don't know if it's going to land, but bear with. So we have the total team and the average. So just to summarize, average revenue for this example, $30,000. Team costs, $5,300. Operating costs, $11,800. This leaves total expenses at $17,000 and leaves the owner before owner's pay at $13,031. Now for this example, because things fluctuate, we see when the owner had to take different owner's pay, which is in this example, owner's draw. So owner's pay can be through owner's draw, which is a distribution. So you're just transferring money from your business bank account to your personal bank account. You have your owner's payroll, which is through a salary. So that's why I have a line item for owner's payroll and then the payroll tax. And then we have retirement contributions. What I did not add here, which I will add, is going to be healthcare premiums. Now, there's something that I did in the CEO's salary where I said the business pays for it, but I did not have, so that means the owner's payroll has to be here. But if we added in If we added in healthcare premium, that means we're going to have to move some of this owner's payroll into here. So you know what? Since I'm here, let me just say owner's payroll for this example is 25. So we see what they're able to like pay themselves. And then premiums, let's say is 350 healthcare premium. So now they can technically have their premium. So now we have a real average of 6,600. So remember, our CEO salary was just under 11,000, our ideal CEO salary. And now we want to go in and, okay, look at everything else. So debt payments. Debt is not a true expense, but it could be like an expense. And for this example, there's 3 different ones. And we have a total of $24.50 of what they pay in addition to their expenses, $24.50 pay off debt. Where does that money come from? It comes from your bank account, right? The money that you hold in your bank account plus revenue minus expenses minus your owner's draw. Whatever profit is left over is going to be used potentially for your cash reserves. So while their profit after owner's pay is 21%, they also have to use an additional 2,400, 2,500 to pay off debt. And then now what's available in the cash reserves or cash available after the debt for this example is $33,981. So where we left off, I believe, was when we have the profit before pay. And now we have the 50% profit margin before pay because that is now going to allow us to be able to pay the full CEO salary that's desired. So this is a CEO salary so that we can always reference it. And then what I did here was say, okay, the owner's payroll is 2,500, but then out of that simplicity, I would increase the CEO salary technically, but we're just going to go with this example. Let's just say now it's 5,000. Let's just leave it. Let's leave it for now. So we're going to leave it for now. And then the 11,000 minus the 2,500, we have 8,400 left over. Another caveat, there is going to be withholding taxes. For this example, we're not going to go through that. Let's just bear with. So now we have the full CEO payroll because then it has the owner's payroll as an employee, payroll taxes, owner's draw just to add up to the full 11,000. And then we have the healthcare premiums. So then now we have profit after payroll. While it is lower in percentage, you're able to pay yourself a full salary because we have 50% profit margin before pay. Okay, now we know why we need to keep half before salary so that we can actually pay ourselves. Okay. And now we still have the same with debt. And then we have flowing in for cash available at 3,000. And I'm not going to show you a breakdown of the actual profit plan as far as like we're going to do a live profit plan, but I'm going to show you what we do next. So, next, now that we have an idea of what we need to immediately work on, what the gap is, we're going to then create a profit plan. So, for this example, this is our revenue model. For this example, we have like an ideal revenue goal of 500,000. We have 3 different categories. We're looking at the past years and then this year split between the 3 categories for this particular example. These are example numbers. This has nothing to do with the client that we've been doing as an example. We are breaking down per category. Maybe there's like different offers. So what I like to do is ask the client for their conversion rates per offer. So then that way we know how many prospects they would need for a monthly basis versus a weekly basis. That's just that example here. And when we go over this revenue model, we are going over pricing strategy, and we're also looking at the direct costs per offer so that we can have an idea of if you're pricing right and we know how to price every offer in a way that produces profitability. So a direct cost for an offer can be like your team member based on their time or like their percentage if they do percentages. Also, like any software that you have specific to clients. So, for example, with our clients, we might invest in a software subscription for a particular like financial software. So that is a direct cost per client. And then once we do that, we're able to finalize what the price should be based off of direct costs, the value of service, and then also what your goals are. So we do that per category. And to keep things simple, we just have three for right now, but we also have space for more if that is something that you have in the future. After looking at the revenue modeling for our profit plan, we then do a full year of revenue planning. And this is fun as well because we have a view of your launch date. So the same categories, right, are going to be used for this launch. So, say if you're launching in a particular month, we're going to highlight it the same color so that we visibly see what you're offering for that calendar year. And then we can map out the revenue based off of the quarter and as well as your launch. And this is where the fun happens for me because we're able to visibly see how you're going to reach your goal. And then if you have like a membership community, I have like a space here and we can just add in like additional memberships, net any churn that you have for your memberships. And then this produces your overall annual revenue. And then it produces, okay, what's like the gap between like what the forecast is versus what your goal was. And then we can see how can we like improve this. And then it gives like a monthly run rate. So this is fun. And then it divides it by the quarter so that we know like what's expected for that particular quarter in revenue. And then I get really geeky when it comes to this last part that I'm going to show you for the profit plan. And that includes an overall view of your money in action. So it's going to show like the beginning bank balance plus the salary from the previous spreadsheet is computed in here. And then we have, okay, how do we divvy up the cash flow based off of like a iteration of profit first? So we have like 15% taxes, and then we have 35% owner's pay. This is just a percentage example based off of profit first. So if you're at 250,000, the owner's pay is going to be 50%. But if you're at 500,000, it'll be 35. That's just an example here. And then we have profit, which is at 10% for this example. Then we have team members and like their pricing here. And then we have advertising. It's going to be a little bit more detail. And this is fun to do because with one of our clients, we mapped out her entire year of launch planning. And we were able to also include areas in which she was investing in particular like advertising or like professional development, and we're able to see how exactly will it impact cash on hand when we're building this out. And then it creates an overview of your total expenses, your profit, and then what I actually on a different example, I have like debt as well. So I typically rebuild as I go along. So this actually is good that I'm doing this because I can like update this template to have debt as well, because we'll map out any debt payments and then see how that impacts cash on hand. And then that way we have the full profit plan for the year. So when you join us as a client in the financial strategy experience, we do this within right 2 weeks after your kickoff call. And I give you some updates on how to prepare for our call, our profit planning session. It's now an intensive. So we kind of go over everything, including like all of your debt on your business and personal, all the things. So then that way we can create a full financial strategy, all stemming from what you need to pay yourself as a CEO. So this is the wealth design plan. And what I love most about like how we operate with our clients is that I am a visual person and I want to see what your goals are for the future. I want to help you understand your money truths and how you operate. So that's like phase one. I want to show you your past financials to tell you a story. That is the second part, which is the phase two. And then I also want to show you where the gaps are with your goals versus where you need to be. That's step three. And then putting everything together in a profit plan that is phase 4. And then in another episode, I'll show you exactly how we work with our clients in the first 30 days of working together. So then that way you're fully supported. So I pray this episode was extremely helpful for you. If you're watching this on YouTube, please put a thumbs up, comment. Let me know how you enjoyed this episode. And if you're listening on the podcast, I highly recommend you coming on YouTube so that you can see this in action. And I also want you to download your copy of the CEO Salary Calculator so that you can see exactly what you must pay yourself from your business. And I'll see you next week. Bye for now.